Anyway, so, kind of moving the focus now to more, financial businesses. And, you were talking about net operating losses and things like that. What do you see there?
So this is probably a good opportunity for me to pull up my slides. Okay. And just to give us, just take a step back with how we're approaching the conversation. Certainly we want to talk about, where we are in the field with respect to the legislation, which we certainly cover in this slide here. But I want to point you to the two areas that I have, put a little magnifying glass next to, just to indicate that we're going to look at them a little bit more closely. Specifically within the CARES Act, I'd like to focus on the relaxation of the net operating loss rules, as well as a relaxation in the 163J interest expense limitation, and I'll certainly explain to you, what that means. So, I guess again, to take a step back, what is a net operating loss? Well, a net operating loss occurs when your deductions for a taxable period exceed your income. So you have, plain and simply a net loss. So from an economic perspective, I think that's easy enough to contemplate. But what does it mean from a tax perspective? Certainly, if you have no income, you have no income tax. But what happens to the overage? Is that lost? Is it carried forward? Is it carried backwards? Well, that's really what this CARES Act has addressed. So prior to 2017, taxpayers could carry NOLs back as well as forward. For example, if your entity has been set up as a C corporation, the net operating loss would be utilized at the corporate level. However, if your entity is an S corporation or a partnership, what we refer to as pass-through entities, the loss would pass through to the individuals who own the entity and would be recognized on that individual's personal tax return. So again, prior to the Tax Cuts and Jobs Act, the 2017 legislation, the treatment of a net operating loss was relatively simple for federal purposes. If you experienced a loss during a tax year, you had the opportunity to carry the loss forward up to 20 years, or you could carry it back 2 years. Prior to the Tax Cuts and Jobs Act, the treatment of an NOL was relatively simple for federal purposes. If a taxpayer experienced a loss during a tax year, the taxpayer had the opportunity to carry that loss forward up to 20 years to offset future income. If a taxpayer preferred to carry the loss back, the NOL was applied to the second preceding tax year first to offset the previously taxed income, could create in a refund. And if there wasn't enough taxable income in the second preceding year to fully use it, the remainder of the NOL could offset taxable income from the first preceding tax year. And of course, the remainder would then be carried forward up to 20 years.
Yeah, that's the creation of tax assets or deferred tax assets, right?
Correct. Yes, that's right. So post-2017, post the Tax Cuts and Jobs Act, the NOL's provisions were adjusted to eliminate the ability to carry back losses the 2 preceding years, but they could be carried forward indefinitely. However, there is now a limitation on the amount that you could bring forward. So what that means is, as soon as a company is profitable, the NOL can only offset 80% of the taxable income that it generates. And as a result, they would now continue to incur tax on the 20% of their income, even though they may have had losses in excess in prior years to offset that. Interestingly, from a pass-through entity perspective, the Tax Cuts and Jobs Act introduced the concept of an excess business loss. So what that meant was a ceiling was effectively placed on the allowable amount of a pass-through loss. Individual taxpayers could deduct a trade or business loss up to $250,000. Married filing joint could deduct up to $500,000, and any losses in excess of those limitations would be disallowed in the current year, but able to be carried forward indefinitely. These rules have now been relaxed in connection with the CARES Act.